for the master day trader through his site, masterdaytrader.com. He continues to teach investors and traders how to be master traders. Ladies and gentlemen, here to present how to trade momentum changes for swing and day trading is Mr. Greg Capra of mastertrader.com. Welcome back to Traders Corner, Greg.
Hey, Rob, thank you. Great intro. Very good.
You're very welcome. Thank you.
All right. Thanks for having me again. Welcome, everybody. So today I'm going to be talking about how to trade momentum changes for swing and day trading. And swing trading, day trading, we use the same methods, same concepts, as I like to call them. We just change the time frames, but I'm going to explain all of that. We're going to look at some different time frame charts, and I'm going to show you how to combine multiple time frames, which is a key factor. And it was a big hurdle for myself because, well, we'll get into that. You know, changing pictures produces different results, but let's get on with it. You're welcome to ask questions as I go along. I'm going to tell you a little bit about myself. I've been doing this for a long time. I was sitting in the same seat as many of you. Well, I don't know how many of you are where you are in your own development, but my point is I started out knowing absolutely zero. But I wanted to make money, and the stock market seemed like a pretty good place to do it. And after several years of trial and error, trying to figure this thing out, some light bulbs moments started to go on, and decided how do I'm going to fund my expenses for trading. Back in the day when I started, it was relatively expensive compared to today because you had to have your own data feed. You know, there wasn't any internet. So, you know, for a retail individual, it was kind of expensive. And, you know, with another individual decided to, hey, you know what, let's throw out a newsletter and help pay for some of this stuff. And we just happened to be in the right place at the right time. It wasn't, we were so smart to see the future of the internet, and things kind of blew up. I can't say they kind of blew up, they did. You know, and there was the internet craze and things went up, and there was this, you know, thirst for information on how to make money in the markets. So from there, as it grew, there were more demands for more information. And, you know, back at the time when we started, it was a fax letter, you know, that thermal paper that used to come out of your machine that was connected to your phone line. So it was really the, you know, the beginning days of individuals trading. And there was a hotline. People would call 800 numbers. We had one of, I think, the first online chat rooms ever. Then we had offices, and we went to hotels and traveled around the world doing seminars. And we opened up a brokerage firm. Master Trader used to be a brokerage firm. And then the stock market crashed in 2001 into 2002, and things began to change and evolve. And back in 2015, had another company basically begging me to sell the old recordings from back in the day and the name, and I did. You know, moved it on. Used to do trading challenges. I've educated so many people. I've been doing this, you know, for many, many years. You see, it started just with the fax letter in '94. So I've educated many individuals and professionals, which was what a wake-up call it was for me when I was educating hedge fund managers and New York Stock Exchange specialists and market makers. I thought, you know, back the day, it was like, wow, these are the gods of the markets. And I come to learn they knew next to nothing about technical analysis. It was about order flow. And of course, prop traders and individuals like you and me. And you'll find my past students speaking the same language as me because they're my students. And today, they either work for a firm, they have their own education firm, or they're professional traders. And it's, you know, a testament to what I've been doing all of these years. And oh, I have to move these screens. So that was the screen I was talking about. Those are the books that Rob mentioned. This was me over 22 years ago at the first Trader Expo. And the theme at that time was teaching people trading, and technology, a T3 concept. You can see the back behind me. I'm the guy in the middle there with a lot more hair. And people at the booth, and we usually gave presentations back in the day, and these expos still go on today, but they're more or less, brokerage firms promoting themselves and software companies, and very little education. So what I call master trader technical strategies. And then this is part of the modules in that strategies where I lay the foundation, candlestick analysis, support and resistance. And this is what I call a thought building lessons. Because as a trader that trades price patterns and absorbing, well, as an intraday trader, many things, multiple time frames, into market analysis, intraday market internals, and so on. It's a lot of information. So we have to create a thought process, and that's what all of these concepts do. So candle language, I'll get into that, how they speak to us. What is support and resistance? What's really support and resistance? It's not about the typical things you learn. Not typical, I mean, almost every day you can't get by with somebody connecting dots to make a trend line or a fib line, which is totally, misleading stuff. Moving average analysis, those are subjective, but how we use them as a visual aid. Volume, as I said, retracements. We did an MT Live, what we do these on Wednesdays, every Wednesday at 12 o'clock on retracements. I can get you the link to that. You're welcome to email me for that. Bar by bar analysis, what is that? You know what, back when I was learning, after I learned patterns and some basic stuff, press that button, money's at risk. Oh, the emotional, drama that started to go on. I was like, why? Nothing's going on here yet. Well, fear of loss. What do I do? How do I manage this? It's really a fear of not knowing what you're doing because you don't actually know what you're doing. That's where education comes in. So bar by bar analysis was a way of like, hey, what does this bar mean relative to other bars, and being objective about the current moment as it related to the past. And market internals and relative strength. How do I analyze a trend? By just looking at price, gaps, failed patterns. I think it's multiple time frames. Money management is a monster in all of this. And how to manage the money, which really is common sense, because none of us would go into a business without a business plan on how to manage our money. But why are we all so stupid when it comes to the markets? And we're willing to press that button out of pure greed that we're going to make a few bucks today. But we forget, hey, there's money management involved here. And I've been doing this so long, and I've seen so many either blow up or come to the realization, even after they've been told, money management is the key. And it's the key to trader psychology. If you think there's something wrong between your ears, I bet you it's more related to money management and a lack of education than something that's really wrong with you. So, if you doubt me, your next trade, if you were going to do 10 shares or 100 shares, up it to 1,000 or 5,000, and watch how your brain starts playing games with you. So that money management and trader psychology is so linked together. We have to prepare for the trading day. And I do that every single day at 9 o'clock. You can go into YouTube. We do it in the green room, and I create a bias for the trading day. So youtube.com/C/master trader. You can find us there. So this is the approach. Well, we have to define all of these concepts, which are built on those modules that I talked about technical analysis and how to use them, and define what we're not going to use, how to use it, why we're going to use it, answering all those questions. We have to understand each concept and how to use it in combination with the others. So as we define how to interpret these and use these concepts together, we build a strategy. So look, candlesticks by themselves are not a strategy. You can know every candlestick name that there is in existence, but it ain't going to make you money, because unless you can combine it with other concepts, which is something as simple as the trend going up, down, or sideways, then you have to practice. It's like anything else. Just because you take a course, that doesn't mean you're a master. You have to practice trading small, track those things in a trading journal. And then from there, you build experience. And one thing, come to realize, market environments change. What was working as an intraday trader yesterday doesn't mean it's working today, right? Whether it's going up, down, or sideways does, but a certain strategy, I look at strategies like a toolbox. And am I using a screwdriver or a hammer today, or what it is, based on a combination of these concepts as it applies to the time frame that I am trading. Now, part of my journey to enlightenment in technical analysis and trading started where everybody else's does. You open up a trading platform, lo and behold, it's loaded with these colorful, fancy indicators. More indicators, more confusion. And this is just the basic stuff. Then they get into, they didn't even have Ichikumi clouds when I started out, but wow, that's like the ultimate color scheme of trading. And where's the trend? What's the support? Where's resistance? Where do you buy? Where do you sell? It's just such a rabbit hole of confusion. But this basic stuff, stochastics, MACDs, the only thing they can do is follow what prices are doing, but they create beliefs about what's going up or down. Overbought and oversold. Those are two of the most confusing terms in the stock market, because every time I say, oh, XYZ is overbought, you're going to say, oh, that got to turn down. That's probably not going to go higher. Oh, yeah, watch this and watch it take off, and vice versa. Like the market's been going down lately. Oversold, overbought are misleading terms. So remove them from your thoughts. Now, we use terms like, oh, prices are extended here, but can they become more extended? Where are they in relation to support and resistance? But with these indicators, what are you faced with when you open up that thing? Because you don't know, if you're starting out, which ones to use, which settings. You hear words like optimized and modified. And then what happens when you change the time frame and they start moving around? And then these trend lines where you're connecting dots and they break and then things reverse again. It is so confusing when you start out in this game. And is this you today? It was me. I no doubt it was me. And I was, so frustrated. I was ready to give up. And I couldn't make no money with this. And the light bulb moment came on when I took them off my chart. So let's get to the subject of the day. So momentum, how do I tell when it's slowing? How do I tell when it's increasing or reversing? Prices have to be doing one of these things in any given time in the moment. So each can form in different ways and they look different. So we have to determine what's the trend of prices. That's a key to these candlestick messages. And where are they in location? Right? So all of this is happening at the same time. What was in a sideways trend can become an uptrend or a downtrend. We need an objective way of monitoring this on an ongoing basis. Now, it says, lastly, do prices confirm by trading above or below a prior bar's high or low? What that means is once we determine that we want to buy something, this is our last piece of confirmation. And so if we have a pattern that says, hey, this is ready to go up, why do I need it to trade above a prior bar's high? Well, that's because that's our first reference point of resistance or support. And I can't tell you how many times that saved me from a particular trade that would not have worked out. And part of the reason for this is, when I'm trading from, let's say it's a swing trading on a daily chart, and depending on how that formed on a smaller time frame intraday, that prior bar's high is going to be some resistance level. Now, depending on how it got there, let's say it's on a 5-minute or a 15-minute chart, it may have been rallying for 2 hours by the time it triggered. This was like, back in the day when I was trading just from daily charts, there were no intraday charts. And I would pick up the phone because you couldn't press the button yourself. And I'd call the broker and say, buy XYZ. And I'd be like, how the hell does it go down every time I buy? And then as I realized, there's intraday time frames involved, I saw why. And it's like, okay, we need a rule. Just so as we're trading, whatever the time frame is, we're not going to look at all these other time frames because that becomes confusing. Let's just make a really simple rule. Let it trade above a prior bar's high for longs and below a prior bar's low for shorts. So how do we tell? Is momentum slowing? We look at the ranges. Are the ranges contracting? The difference between the high and the low. If they're contracting, momentum is slowing. Because if the ranges were larger before and now they're contracting, momentum is slowing down to some degree. I don't know to what degree, and I have to look at the rest of the chart, but we start with the basics. Bodies. What are bodies? The difference between the open and close. That's your candlestick. The difference between the open and close are called candle bodies. So if the candle bodies are contracting, right, they're getting smaller, right? Momentum is slowing. So we're setting up some rules and guidelines for our thought process here. So the distance between reversals contract. Well, so if you've got a multiple set of red bars and you get a green bar and it starts to move up and then it goes down again and you get another set of red bars and a green bar, the difference between those reversals coming together tells me momentum is slowing. And lastly, the strongest is going to be the distance between the pivots. And that's why I've got these little half moon kind of shapes there under those pivots where you can see those red dots. Those are called pivot lows. How do I define them? I define them by just a bar with 3 higher lows to the left and right. Simple as could be, nothing proprietary. Why 3? Because I've looked at 2, 1, 4, 6, 12. 3 is a happy medium. Works. And a pivot high, 3 higher low bars to the left and right. And so we continue to watch these series of bars and pivots and see, is momentum increasing? Is it decreasing? And over what length of time? Okay. Now, as we look at individual candles, what I'm showing you here is exactly that. That big green candle, momentum increased. Now, all of these other candles where they got these small candle bodies, call it a topping tail, call it, I don't know, when the tails are in the top and on the bottom. I think I remember my candlestick terms, maybe a dragonfly doji, if that's something like that, or a body. Who cares? All right. Bottoming tail bar, right? The body's at the top. It's a small candle body, momentum slowing. And then lastly, I've got a small range and a small body. Momentum is slowing. Common sense. And then we got the red combination where it went down, it goes up. You got tails, you got small bodies, you got small bodies with small ranges. And so here we're taking each one of these little pieces to build together. Of them by themselves, it's just a thought. Momentum slowed there. What do I do with that? Nothing. I need more information. So reviewing, wide range bars, right? They tell us about emotion, commitment, right? That is momentum increasing. So if you get a wide bar to the downside, like we saw recently, a couple of them, those are power bars. They say prices are going lower. Well, lower to where? I mean, if you heard me speak before, I say look to the left. I don't need any indicators. I don't need no fib lines. Just look to the left and see where there were buyers before, where there was a prior pivot low that it went up from. And from there, that's my next thought. There are buyers down there. What's going to happen now? Does momentum slow down when it gets there? How does it slow down? Is it a bottoming tail type of bar, that green bar that says range expansion? where the range expanded, but the body is small, meaning it went down and it came back up, but momentum slowed. So I'm gathering information based on what the market is telling me, not indicators. It's based on what people are doing, trades with real money. And it tells me, what did they experience? Did they sell the low and prices rip back up where shorts maybe are caught? Was there big demand down there where institutions stepped up and took all those shares and pushed it back up again, which would be associated with volume? Take a look, it's not today's subject, but volume comes into play. So I said wide range bars, commitment and emotion. Well, a wide range bar is an expansion bar. Right? So an expansion bar just means that it's a big range compared to the others. Now, bottoming tails and topping tails can be small bars or they could be big bars. If they're topping tails or bottoming tails and they're range expansion bars, there was a motion there and there was a giant turn. Now, wide range bars that happen after multiple bars moving in one direction communicates to me that the Johnny-come-latelys are jumping on board at the worst time. They were waiting so bad for that pullback that didn't happen. Now it's going up forever. So they jump on board. Wide range bar, big participation. That tells me that momentum is ready to slow. Well, that's a thought. Does it really slow? How do I know? The range contracts, or the bodies contract. And the same thing on the downside. If you've ever sold the bottom of a move after it's been going down for a long time, go look at your records if you're keeping them. I bet you it's a wide range bar. You were so convinced it was going to zero, you hit that button, you didn't care what the price was. I know because I've done it. I was there. And this is how I discovered these patterns 25, 30 years ago. It's like, Greg, you did that like 3 times in a row. There must be a picture that depicts selling the bottom. It was a wide range bar. And they typically form its support. It's like, how the hell would anybody sell its support? Because they don't even know it's support. That's how much of a disadvantage you are starting out, that you don't even know the basics. And I'm not saying everybody in the room, but this is how we start out. And it's the reality of trading. All right, so we're building this thought process. Our first and second support and resistance. The first point of resistance in any time frame is the prior bar's high. Right? That's what triggers us if we're going long, and support the prior bar's low. The second points of support and resistance are pivots. And I've already explained the definition. And I've got this little stick drawing here that depicts for you what's a pivot high, that red dot there. So when does it become a red dot? After there are 3 bars to the right. It's already 3 to the left. You need those 3 bars to the right. So you have software that can do this. Almost any software package can do this. I think all of them can. Some need a little more programming maybe or another, but most of them are built in. And it's going to take those 3 bars. And then as it comes down and 3 bars up, it forms a pivot low, second support, and the whole process continues. And that tells us whether it's in an uptrend, a downtrend, or a sideways trend. And we just continue what we call de factory work. Now, as this changes over time, we see different degrees of momentum increasing or decreasing. So as you look at this slide, as it's going to the left to right, you see the right one is the most potent, where it went up, the momentum stalled with that topping tail, small body, and then it increased again to the downside. So as we look at what might be extended, right, that's what the left side of the chart shows. As it's going up, we see, okay, that was the least potent turn. Maybe it's going to pull back, versus the one that's the most potent. It's like that thing went up with a wide range bar. It went higher. It formed a topping tail. Somebody bought the high and it came down real hard. What is somebody going to do? They're going to hit the bid. And just, again, it's producing thoughts. So as we're looking at this, right, we recognize how fast prices are moving. And when they're moving fast to the downside or the upside, that energy is not going to dissipate quickly. So when I see prices come down fast and I now see momentum slowing, Do I want to trade that as a counter trend trade? It's a choice. Maybe I will, depends on how it came down. However, my expectation is it's going to go lower because it came down so fast. Now, what we see on this slide is that it did go down again. And then when it came down to the bottoming tail bar, it eventually, momentum began to slow. Makes sense. That's where buyers were before. Doesn't mean it can't go lower. But then it went up with a big green bar, a big range expansion bar. That's a power bar. And the distance between those lows now contracted. So there was even slowing momentum. And this is how bottoming process begins. And then you see as it went further along, it then made a higher low and a green bar. And now it starts to move up. So correcting over time, whether you call it a base, whether you call it possibly a head and shoulders bottom, call it whatever you want, when you recognize what I'm explaining to you today in an objective, systematic way, you know that buyers are stepping up, and it's more likely going to have a larger retracement because of the length of the consolidation and the slowing momentum. Okay. Multiple time frames. Pictures begin to change when we do this. It can become a little confusing when we do that. I know it was for me as I began to change these. So as we focus on, and then MTF, short for multiple time frames, and the alignment of these trends and these inflection points, we're going to say, are they aligned with each other? Well, it's kind of rare for them all to be because there's so many different time frames you could look at, right? But they don't have to be. And I say, if you're going to expect them to all be aligned, which is, again, I'm sharing with you my own experience over the years. I knew if everything was aligned, I'd have the perfect trade. Granted, true. But I might have to wait 3 months for everything to line up, the weekly, the daily, the 60-minute, and so on and so forth. So I realized that wasn't working either for an active individual investor and trader. So our job is to pick the time frame that we're going to use for our bias. That's our objective, where we're getting our primary information from. And then we're looking for our other time frames to be aligned, either to add or for entry. And then lastly, don't trade from a lower time frame without a trading plan. I had many traders. I mean, years ago, I had multiple offices, and traders used to come to the office, and I would sit with them. And at the end of the day, I'd be like, "Why did you trade that?" And it's like, "Well, I was trading from the 1 minute, and you know what? My stop was so small, I knew that I'd only lose a little bit of money." I said, "Yeah, but you lost a little bit of money 20 times." It's like that edge that cuts you to ribbons. So you got to have a bias from a higher time frame. And I'm not saying a 1 minute, but you need to pick a higher time frame. Is it going up, down, or sideways? Where's support and resistance? And then you can go to a lower time frame if you choose to. It's not that you can't trade from that higher time frame. This slide shows how things evolve in different time frames. And the bigger bars are the higher time frame. And so what it's showing you is the transition from red to green here as prices are moving down. So let's assume that those bigger bars are your higher time frame, and you see they're coming down to support. And now you go down to your lower time frame and you see momentum slow down. Like, here comes the turn. And now you're saying, okay, if it trades above a prior bar's high, that's my trigger, because the higher time frame is going up. It's at support. Momentum is slowing. And now I can get in with a initial position. And then as things evolve further, well, we can add to positions. That's part of money management, right? So when you learn how to properly use money management and how you can add to positions, your profits can exponentially increase. But that's a higher level of understanding how to use, money management and trade sizing. And lastly, that lower time frame, you see more details where we can see multiple bars. Now, you have to realize as you expand data, you see more information. And as you contract data, you see less information. It's the way it is. So we have to pick what time frames we're going to contract and expand. Otherwise, we look at too much and we become thoroughly confused. We don't have to look at everything. It's not necessary. Money management and understanding how to use these multiple time frames will get you in at the appropriate moment. Then you manage. So here's a chart. It's a recent chart where prices had pulled back. Actually, I think it's the Qs. Prices had pulled back to the area of the prior pivot low. And as you can see, the candle body begin to contract. Look at that bottoming tail bar there. But then it picked up again. Look at the big red bar just prior to the green star there where it breaks down. And okay, here we go. And it's going to go lower. This is where the bar by bar analysis comes in. Then right above the star, where PL is marked, remember, it doesn't become a pivot low until 3 bars to the right. I don't know it's going to be a pivot low, but I know it's in an area of prior support and the momentum is slowing. Then we get a green range expansion bar. Now, during that turn, do you want to trade this long because it's that there? It's a choice. It's not a right or wrong. However, once that green bar forms, excuse me, there are put spreads that can be done, credit spreads. You can sell an out of the money put. Maybe you want to buy the Qs. Excuse me, let me grab some water here, my boys. So there are different vehicles for making money. Selling puts, selling credit spreads, buying the underlying, and so on. Day trading. The chart on the right is an intraday chart. And here we can see as prices are coming down to our reference point on the daily time frame, the momentum begins to slow. We see the distance between the lows contracting, and then they flatten out. So from the higher time frame, moving to the lower time frame, I'm zeroing in on what's happening to get ready to trade the turn. Now, whether that's intraday trading, which is fine. I can trade futures, which is fine. It's just a different vehicle. I can sell a credit spread. I can buy a call. So there's lots of different ways. And it doesn't mean you have to do them all. I'm just pointing out to you there's a lot of different options on how to make money with that vehicle. Here's another example. Prices are coming down. Are they going to stop coming down as they come into that gap fill area? Well, bottoming tail bar, small body, does it break a prior bar's high? Nope, keeps coming down. What do they call that? An inverted hammer doji? Who cares? It's a small candle body. Momentum is slowing down. It still hasn't made a turn. Big green bar, it's made a turn. It's in an uptrend. Press the button. Where do you put the stop? Below the lows. Well, how do I figure how much money? Well, what's the difference? How far is it? Is it 3 points? Is it 8 points? How much money are you willing to risk? $100, $500? Now share size it accordingly. If it breaks the lows, you lose your $100. Now your psychology is free because you're not in a situation where you're thinking, oh my God, if this thing ever breaks the lows, I don't know how I'm going to pay the mortgage. How maybe, I'm going to have a heart attack, whatever. Well, no, this is a calculated loss. Whatever, if I lose this, it ain't going to change my life. Now you're free to manage the trade according to your trading plan. And the one on the right, it's the intraday time frame. We're doing the same thing. The pivot lows are coming together. It's beginning to make the turn. The higher time frame is telling me I'm in the right place to be looking at this intraday chart. As it was coming down, it might form similar patterns, but you're not in the right place. You're not in the right location yet. So patterns are one part. Trend is another part. Location is another part. Now we're building a strategy. Now, how do we want to implement our strategy? Through what vehicle? Credit spreads, calls, puts, buy the stock, right? All good choices. Some can be more profitable than others, depending on what the stock does. As you know, for a credit spread, maybe it went sideways for 4 more days. But if the spread is expiring at the end of the week, which we love to do, you get to keep the money. But if it goes up and you buy a call, you'll make a heck of a lot more money. We're buying the stock. So swing trading, we're just following the same thing that I've told you. And so as something develops, you see that igniting bar where it breaks down under the lows. Well, it went sideways for quite a while, and now it breaks down with a range expansion bar. This thing's going lower to where? Where's support? Well, there's none here. It's going low. It's going to keep going down until it reaches support or creates it. So now, as we see bottoming tail bars and the trend is down, I see momentum is slowing. Do I want to go long? No, the trend is down. Not support yet. Momentum begins to slow down. How long has it been going down? Is it at support yet? How powerful is the pattern? And then you can see where it says 2-bar 180 reversal, same as a topping tail, which means it went up and it came back down again. Call it whatever you want. It failed to go up and got slammed back down. That 180 is a range expansion reversal. It's powerful. So I'm just reiterating again. Green candle up, red candle back down. If I compress it, it looks like a topping tail bar. And that says it's going lower because the trend is down. Lastly, at the bottom where it says, oh boy, a 180. That's been going down for a while. I would say, well, what's to the left? Is it at support? Yeah, it's in the right place. And it broke down and it reversed back up again. It's starting a bottoming process. And it just, the evolution of what we're doing here just revolves over and over and over again. Another example, a multiple retest of a prior low, bullish wide range bar. The distance between those lows there are close together, and then it gaps up above resistance. I believe it's going to go higher because of that. Really, Greg? How do you get on? Well, it's got to trade above a prior bar's high at a minimum. And then the next bar was a down red bar. And you see that green star there right before that red bar. And then it was followed by a green bar. So that's a bullish 180 where it was a range expansion and it went back up. And then trading above that, you're in. Stop below those 2 bars there. Give or take a little leeway. And you see that second star, it gaps down. And then at that point, you're like, oh my God, it's going to fail. But then it reverses back up again. And when you see that gap turn into a reversal bar and it's green back at the high, you know you got it locked. As sure as you can be, as you can, right? Anything can happen, but a gap down that gets bought with a bullish pattern tells you institutions are stepping up, and it closed at the high. It's got it. I use the word gotta because that's my belief system. When I see something like that, I'm so sure it's going to go up. I'm going to add at that point. And then you're just going to see what happens bar by bar. And if you think, oh, it won't go any higher. Well, did it break a prior bar's low yet? Your first reference point of support? No. Well, stick with it. Usually that last bar is a big range expansion bar. That's getting close to the end of the move short term anyway. Doesn't mean it's going to get killed. This is today, folks. This is today. I captured this before coming on. You see those topping tails? They have the big red tail where it broke out above the highs there at around 10 o'clock. And the little red line there, that was yesterday's close. And it's right at that, all of that resistance. I talked about this pre-market. If it could get through there today, odds are the markets could go higher, but they couldn't. And it went up there and the momentum slowed, and then it slowed some more. And then buyers just threw in the towel. That's right, the psychology of patterns. They couldn't take it any higher. And because it's a bearish market environment, institutions said, hey, the hell with this. It ain't working today. Hit the bid. And down it went. And it's been stabilizing since. I can see on my other charts there, it's right about where it is, give or take. Still, to this time, it began to stabilize. But if we had more data, you'd see over to the left there, it's right near a prior low. It's always about that. So here's a 5-minute chart of SPX. This is an NYSE tick indicator. It's an intraday market internal that I use each day. We talk about in the green room how strong the market is or the lack thereof, and apply the same pivots. The same thing I'm telling you right here. What's the difference between pivots? Is it at support? Are the ranges contracting? What's the location? What's the trend? And I think this was yesterday. So as you monitor this, reiterating, we're building a thought process, folks. And the thought process puts you in charge. You decide the time frames to use. You have an objective, clear, step-by-step method for understanding whether prices are going up, down, sideways, where's the location, what's the turn. You know, in my courses, I get into, utilizing things like intraday market internals, end of day market internals. So, and what we do here is we educate, and I've been doing it for 30 years. As I explained at the beginning, got a lot of students and people that are out there, preaching what I taught them. And some of the names are very well known, and you can read them, some of them on a website. You can read about it. So the trader's mindset, I've explained that to you in some detail here. Once you've learned a pattern that suggests the future, it's going to produce expectations for that result, and it should. But are you looking at the right thing? Do you have the other concepts aligned? So these expectations can lead to failure with technical trading if they're not in alignment. Trend, support, resistance, momentum, patterns. Right? Candlesticks are not a strategy. So without a method to update new information, which I provided you to some degree here, right? Are ranges expanding? Are they contracting? Where are the pivots? So on and so forth. They keep your expectation with what's happening now, the new information. So what's happened in the past, as you've all heard, doesn't equal the future. But the past and the present suggest the future, and that's what we do as price pattern traders. The bar by bar analysis that I've explained to you is what allows you to keep in the present. Does it keep going up? Does the momentum stall? Where is support? Where is resistance? So on and so forth, multiple time frames. It's a thought building process. Okay. All right, you can go to the Master Trader website, read about education. That's the first link there, mastertrader.com/trading-education. And this is the beginning of that page where you can read our view on education. And I think you've gotten the point about this industry, which honestly, I can't hold it against them to a certain degree because, it's just one hand handing down to another the beliefs of the past and the misleading information about indicators. So at one point, I kind of despised the whole thing because the years it took me to figure it out, but it ended up in a good place. What I'm explaining to you today. So I've educated thousands of people over these 30 years, right? And it's a testament to what, I do. And so mastertrader.com/swing $$ will bring you right to the swing trading overview of that course. And mastertrader.com/spread trader, you'll see trading strategy, directional trading strategies and spreads and stuff. And so at any of them, if you choose to purchase any of them, today, enter that coupon code options20 and it'll reduce the price of any of those courses by 20%. We do live coaching every single month with our members. Right? And we review, kind of like what we're doing here on a particular concept and putting them together, because the education doesn't stop at Master Trader. We continue that and we reinforce it. Like anything else, you need to reinforce your strategies. And even, look, if you're a tennis player, a golfer, golfers go out there and they hit the ball. They're professional guys and they hit their balls on a putting green all day long to practice and practice, or to keep what they've done, green or real. And so this is the same thing. You have to keep practicing even more so because market environments change. And so you need the ability and tools to change with that. And so my time is up. I hope you've enjoyed this. Visit Master Trader, visit our YouTube channel. We're on Facebook. And recently, look, we do our pre-market education as well as our MT Lives on Wednesday. They stream to YouTube, they stream to Facebook. You can log into and be in the chat room with us. And we do that all. There's no cost for it. So get to know us and let's see where we go. Thank you.
Hey, thank you so much for all the great information. It's always an honor to have you on our show.